Welcome! Today we're jumping right into a super important provision in the new Income Tax Act 2025, Section 76. This section is all about how you calculate capital gains on market-linked debentures. Now, for any tax professional, advisor, or even a serious investor, getting a handle on this section isn't just nice to have, it's essential. Okay, let's get into it.
So let's kick things off with a quick scenario. Imagine you buy a market-linked debenture and you hold onto it for a full 36 months, 3 years. Now, based on the usual rules for debt instruments, you'd think any profit would be a long-term capital gain, right? Makes perfect sense. Well, under Section 76, the answer is a hard no. And this is exactly the kind of surprising result this rule creates, and we're here to explain precisely why that is.
Here's our game plan for this explainer. First, we'll talk about the puzzle that MLDs used to be for tax purposes. Then we'll really dig into Section 76, our new rulebook. We'll break down how to do the math, walk through a real-world example, cover the compliance side of things and common mistakes to avoid, and then wrap it all up with the key takeaways you need to remember. You see, for a very long time, how to tax the profits from MLDs was, well, it was a bit of a mess. People would argue, should it be taxed as interest income, or is it a capital gain? And if it's a capital gain, is it short-term or long-term? This gray area created a lot of uncertainty for taxpayers. The good news is, the new law sweeps all that ambiguity away and gives us total certainty.
So what exactly is a market-linked debenture? The Act gives us a pretty clear definition. At its core, it's a debt instrument. But, and this is the important part, the returns aren't fixed. They're linked to how something else performs, like the Nifty 50 index. It's this hybrid nature, part debt and part derivative-style return, that made it so tricky and why it needed its own special tax rule.
And that special provision is Section 76. This is now the final word, the definitive guide for taxing gains from MLDs. It just wipes away all the old debates by setting up a clear, simple set of rules that everyone has to follow. So let's see how it's put together.
Now, for all you seasoned professionals out there, this whole setup might feel a bit familiar. And you'd be right. Section 76 of the new 2025 Act isn't brand new. It actually just carries forward the same ideas that were first brought in under Section 50AA of the old 1961 Act. This is great because it gives us continuity and solidifies an existing policy, rather than throwing a whole new concept at us.
Okay, this is really the heart of it all. Let's break down the main features. The absolute #1 thing to remember is this. By law, any gain from an MLD is treated as a short-term capital gain. It does not matter if you held it for 1 year or 10 years. It's always short-term, period. Because of this special rule, it overrides all the general capital gains rules, and that leads to 2 huge consequences. First, you don't get the benefit of indexation to adjust for inflation. And second, subsection 4 of Section 76 is very clear. You cannot deduct any securities transactions tax you paid. So it's a completely self-contained, ring-fenced set of rules. So now that we know the ground rules, how do we actually calculate the gain? Let's move on to the computation part. And thankfully, the law doesn't make us guess. It gives us a very simple direct formula.
And here it is, as simple as that. Section 76, subsection 3 tells us the taxable gain, which we'll call X, is just A minus B minus C. Now let's quickly look at what each of those letters stands for.
A is the full value of consideration. In simple terms, this is just the gross amount of money you get when you sell the MLD or when it matures. It's your total cash inflow from the deal. Component B is even easier. It's your cost of acquisition. This is just the price you paid to buy the MLD in the first place. It's your initial investment.
And finally, we have C. This is for any expenses you paid that were directly for the purpose of the sale. We're talking about things like brokerage fees. The key phrase here is wholly and exclusively, which just means you need to have the documents to prove these costs were directly related.
All right, we've gone through the principles and the formula. Now let's put it all together with a quick example to see exactly how this works in practice.
So let's take a look at Mr. Sharma. He invests 10 lakh rupees. Now check out the holding period. 30 months. That's well over the usual limit for something to become long-term. At maturity, he gets back 12,50,000 and his expenses were 2,000 rupees. So we plug these numbers into our formula. A is 12,50,000, B is 10 lakh rupees, and C is 2,000. That gives us a gain of 2,48,000 rupees. And this perfectly shows the power of this law. Even though he held it for 30 months, this entire gain is a short-term capital gain, and it gets taxed at his normal income slab rate. Now, knowing how to do the math is just one part of the job. Reporting it correctly and staying compliant is just as crucial. So let's shift gears and talk about the practical side of things and some common mistakes that we all need to help our clients avoid.
When it comes to compliance, it's pretty straightforward. You have to report this gain properly in the capital gains schedule of the tax return. And of course, keeping detailed records is a must. Now, let's talk about the pitfalls. The number one mistake is classifying the gain as long-term just because of the holding period. You can't do it. The second big mistake is trying to apply indexation. That benefit is just not available here. And the third is trying to claim a deduction for STT paid. All three of these are total non-starters under the law.
Okay, we've covered the history, the law, the calculation, and compliance. Let's wrap it all up and boil it down to the essential points you need to remember about Section 76. Here are your 5 key takeaways. 1. The law gives us absolute certainty. All gains on MLDs are taxed as short-term capital gains. 2. The holding period is legally irrelevant. The law has made the decision for us. 3. The calculation is a simple A minus B minus C. 4. Don't look for any extra tax benefits like indexation or an STT deduction. They're not allowed. And 5. It's worth remembering that this section has a broad scope, so it could apply to other securities too. Essentially, Section 76 creates a really clear, simple, and strict tax system for these instruments. And that's our deep dive into Section 76. We really hope this explainer has made this important provision much clearer for you and your practice. Thank you so much for watching. If you found this valuable, we'd really appreciate a like and a subscription. And please share it with other professionals in your network.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.